Ladies and gentlemen, welcome back to your end of the day update with AMC Stock. It's been a very strong day. AMC up about 6.61% at the time of recording this video, currently higher than the 100-day moving average. So let's break this down a little bit. AMC rallied above the 50-day and the 100-day moving average today. What does that mean? Well, usually when that happens, tends to signal a further breakout. You're going to get, coming tomorrow, a lot of these green dots, these technical indicators that are going to be screaming at you a rally is coming. Because when you break those 9 times out of 10, it shows a lot of strength. And 9 times out of 10, the stock will continue to rally. But tomorrow is going to be a very interesting day because we'll talk about it here in this video. But as you guys know, CPI numbers come out tomorrow. And what's specifically interesting about this is you're expecting your headline CPI, your not core CPI, so including everything, all baskets of goods and services, you're expecting that to actually fall tomorrow, whereas banks and analysts are expecting your core CPI to move higher. So you're actually expecting core CPI to move higher than headline CPI. That would be the first time that has happened throughout the last, 15-ish months where inflation has been going higher. So tomorrow could be a very interesting day. Now, on top of that, cost to borrow rates continue to soar with AMC stock likely helping to fuel some of this rally. And if you guys have not seen the last video, AMC also made an acquisition over the last couple of days and weeks that is helping to add some bullishness to AMC stock here today. We're going to get into all of this in depth here in this video. Hit the like button and subscribe to the channel if you have not already. And if you guys want to come trade with me live in real time, link down below in the description of this video. We did make a high risk, high reward kind of CPI trade for the end of this week that I think could get very interesting given where the markets are currently at. Now, let's get into it, guys. First things first, let's talk about this acquisition here briefly. It's going to be the thing we're going to focus the least amount of time on because we talked about it extensively in the last video. But AMC did disclose they purchased 16.58 million shares of National Sin Media, about 9.1% of the shares outstanding. This makes AMC the second largest investor in this company, right behind Sinmark Holdings, which owns 48.5 million shares and about 27.4% of the shares outstanding. Now, last quarter, Sin Media said that there was substantial doubt that they will be able to stay in business. The stock plunged 58% since then in the past 3 months, and now the stock is up 63.23% here today. It is an overall cheap stock, so this wasn't a huge acquisition, but it does show AMC is doing something. Either they've done their due diligence on this company, and probably a lot of value to be added. After all, AMC's up 65% after today alone. So a reason to be bullish there. Now, AMC is well outperforming its rival Sinmark, which is only up 2.22% right here and right now. But what is interesting about the theoretical business in and of itself, the publicly listed companies are hitting 6 to 12 month highs right now, whereas AMC is well off of that 6 to 12 month high. This is because of the arbitrage trade that is starting to look more and more unlikely to get the stamp of approval coming April 27th. Now, everyone still expects this to happen, and you can see this prevalent in the option activity, and we'll cover that here briefly in this video. But when everyone is so bearish, you probably don't want to be bearish as well. And I don't think it's, clean cut like the markets think it is. And we've covered that a lot basically in every single video, so I don't want to get into that all too much. But for those main reasons, I am bullish. Now, let's talk the CPI report before we get into specifically what happened in the markets today, as well as with AMC stock. So this article says US CPI banks preview inflation softening, good news on the horizon. It says the annual inflation is expected to have risen by 5.2% year on year after increasing by 6% in February. The core reading, however, is foreseen at 5.6% from 5.5% previously. On a monthly basis, the CPI is forecasted at 0.3%, while the core CPI is expected at 0.3%. So let's look at these year-over-year numbers from what we got last year. Now, or last month, year-over-year, right? Now, last reading, headline inflation was 6%. Well, now you're expecting that to drop to 5.2% on a year-over-year basis, but you're expecting core CPI to come in at 5.6%, and it was previously 5.5%. So headline inflation last month was 6%. Core inflation year over year was 5.5%. Now you're expecting a flip-flop. Now you're expecting headline inflation at 5.2% year over year, and headline, shouldn't say headline, core CPI year over year to come in at 5.6%. So you're expecting the total opposite here. Now, if that does happen, you're going to see the markets likely get very concerned very quickly of sticky inflation. A lot of people still expect inflation to basically plummet. If you take out food and energy and inflation is still going higher on a core basis compared to headline inflation, which includes food and energy, that's a problem. And that's a problem for the Fed. That's a problem for the markets, because a lot or most of this rally that you have seen recently in the last 3 months or so is based off of the Fed giving you rate cuts by the end of this year. And if those rate cuts do not come, that is a big problem. At the same time, as inflation continues to stay higher for longer, the Fed cannot ease policy. That leads you further and further down the rabbit hole into recessionary territory. Now, I will link this article down below in the description of this video so you guys can look at all of these different bank comments. I think this is pretty interesting to read. Just a couple of these that I do want to point out. It's the overall same narrative kind of that you've been seeing across the board. These banks kind of all are in agreement that headline inflation is going to go down and core is going to go higher. Like, nobody's really arguing that. Now, let's read Wells Fargo and Citi, their notes that they put out today. So Wells Fargo says, quote, after rising 0.4% in February, we look for the CPI to moderate to a 0.2% gain in March, with the initial surge in oil/gasoline prices stemming from Russia's invasion of Ukraine on a full year basis behind us. CPI, when measured on a year-over-year basis, should fall to 5.1% in March from 6% in February. However, another elevated reading in the core CPI is likely to indicate that the recent trend in inflation is little improved. Excluding food and energy, we look for the CPI to rise 0.4% and remain close to 5% on a 3-month annualized basis. A further slowdown in core inflation is likely coming as the year progresses, but we doubt it will be evident in this CPI release. So Wells Fargo expecting inflation to head down throughout this year. They're expecting core to go higher, and they don't think we're going to get a big downside surprise that would be bullish for the markets coming tomorrow. Now, Citi says, quote, we expect an increase in core CPI in March that is on the border between 0.4% and 0.5% month over month, but at 0.456%, the forecast would again round to 0.5% month over month, with risks tilted towards the upside for most components through the modest downside risk for the largest component of shelter prices. Most forecasts over the next few months will likely be factoring in a gradual slowing in shelter prices that has long been expected. A large 1-month drop is possible, but unlikely. So again, Citi expecting core inflation to move higher to 0.5% month over month. Let's just do some simple math here. 0.5% times, I need times, 0.5% times 12. That's 6% core inflation year over year on a monthly basis. So that's more of a current kind of where is inflation going. If it just continued on its same path, it would be 6% on a year over year basis in 2024, in March of 2024. That's a problem for the Fed. And likely the only way out of this is a recession at this point. And I think that's going to become more and more obvious. And really, tomorrow's reading will help solidify that. It will also help solidify that the Fed will have to stay higher for longer. And like I said, the reason markets have been rallying specifically in technology is because of the bank crisis. Seemingly large tech has been this rush to safety because they have a lot of money in the bank. They don't need to raise capital, but also at the same time, right, they are your stable companies. But at this point, their valuations are way overstretched, baking in Fed rate cuts by the end of this year, which the Fed has said over and over again, they're not going to cut rates. And especially if inflation continues to go higher, 6% month over month as an annualized running number, right? And that would be 0.5% core inflation month over month. That would be very negative. That would be very, very negative. So those are kind of your expectations. If we go ahead and refresh this and look at trading economics, the actual expectations over here, the forecast for tomorrow's core inflation rate year over year is expected to come in at 5.5%. The headline number year over year for CPI is expected to come in at 5.3%. So there is the discrepancy there. And the bigger the gap is, let's say core inflation comes in at 5.7%, headline inflation comes in at 5.1%. That's going to be a big gap between the two. That's going to show core inflation, your core services really are very sticky and they're not going away. Now, core inflation month over month, you are expecting that to come in at 0.4%. So core inflation month over month, that's going to be big, as well as the year over year comparison between core and headline. If those things are negative, well, you're going to have a very bad day in the markets tomorrow. Now, 2 p.m. as well tomorrow, you're going to get the FOMC minutes. Now, we've talked about this before, but we'll say it again. The FOMC minutes is a transcript basically of the last Fed meeting. So you're going to get a little bit more information and hopefully a little bit more clarity on why the Fed did what they did at the last meeting. There was a pretty good cause to, introduce a rate pause. That we know did not happen. Why did that not happen? That's going to be key coming out with the FOMC minutes tomorrow. So that is the big data that you are going to get tomorrow. Inflation data, just to be clear, comes out at 8:30 in the morning. So if you're trying to trade any options or anything like that, you got to finalize your trades by the end of the day today. The FOMC minutes will be at 2 p.m. So not such a big rush to, make a trade to play that or whatnot. So that's what you got. Now, the markets right now are expecting a 25 basis point rate hike in May, a 70.3% chance of that 25 basis point rate hike. To be more clear, 29.7% of investors are expecting the Fed to pause. So you are expecting the Fed to raise on May 3rd. Depending on the CPI report comes out, you might start to price in another rate hike at the next Fed meeting. Now, what's interesting is by June 14th, the markets are pretty close to actually pricing in a rate cut. 26.2% of investors are pricing in a rate cut by that June 14th meeting. Another, 65.5% of investors are expecting the Fed to pause in June. If this inflation report is hot, well, you're going to quickly start to price in another rate hike June 14th, and probably another one in July. And futures are still looking like the Fed will pause into July and start to cut actually in September, or possibly even raise rates again in September. All depends on the course of inflation. And there's actually a 2.4% chance that the Fed funds rate will be 5.75 to 6% by September. So there's a 2% chance that the federal funds rate is going to hit 6% by September. If this inflation report is bad, well, your odds are going to go up a lot. And that's going to be very bad for the same very 20-ish stocks that have caused this market to rally. Think your Apples, your Microsofts, your Googles, your Teslas, your Nvidias, your Metas, right? Your Facebook. Those companies would take a beating tomorrow. Now, AMC stock right here and right now is up about 7%. If we take a look at the short interest data and the cost to borrow rates, the live short interest or free float sitting at 25.15%, really has not moved over the last couple of days. Over the last week, it's remained stubbornly at the same exact level, which is kind of weird. Now, the live short interest, and this is represented in millions of shares that are currently sold short, still sits at about 130 million. Looks like about 500,000 shares were sold short here today. Cost to borrow average of 930.5%. Cost to borrow max of 1,050%. Cost to borrow minimum says 8%. Last reading that we got was around 368%. Take that how you will. Interactive Brokers here today telling us there's about 200,000 shares that are currently available to be lent out with a cost of borrow rate of about 842.18%. So some very high cost of borrow rates across the board, high short interest. Now, what I want to say about a potentially very red day in the markets tomorrow is that AMC lately has been going higher as the markets have been falling. And that's a very interesting dynamic because why is that happening? Well, I would argue that the collateral that is backing these AMC short positions, such as Apple, when these stocks are going lower, it's putting more pressure on those shorts. It's driving up cost to borrow rates, and that's what we've seen over the past couple of days. But it also means that hedge funds and institutions need to put more collateral into their AMC short positions to remain in those positions because those margin levels are 100%. So it's a 1-to-1 ratio. If your collateral goes down $100 million, you got to put $100 million more dollars into your position to remain in an AMC short position. Hopefully that made some sense. Sounds confusing, but it's not all that confusing. Don't get lost in the sauce here. Now, I would argue that is probably a reason why when the markets have been falling, AMC stock has been rising. Also, if you don't put more collateral in your AMC short position, you have to mitigate risk somehow. And that's what collateral is all about. Mitigating risk for the banks, for the institutional investors, for other parties that these hedge funds are taking short positions from, that are borrowing shares from. And some of that upside hedging could ultimately be, buying some of the options. And that's kind of what we've been seeing as of recently. If you take a look at the option expiration for this Friday, for April 14th, you got in the money calls at 78,000, out the money calls at 74,000. Look at the put side here. 13,000 puts in the money, 125,000 puts out of the money. So you've seen a lot of options run into the money over the last couple of days when you have gotten over a 40% cumulative rally in AMC stock. That is pretty damn aggressive. Now, if you take a look at the technicals on AMC sitting at $5.60 per share above the 100-day moving average. If you do get a close and even into an after hours close above that 100-day moving average, you probably go much higher. You just smoked through the 50 and now the 100-day moving averages today in intraday trading, as well as right now heading into the end of the day. If you do get that close above $5.57 per share, that is that 100-day moving average, you probably make your way to that 200-day moving average sooner rather than later. Now, keep in mind, you were just at, $8.50 per share before the selling happened, before that March 14th vote. The day you were actually there was February 28th. To get back to those levels is not unreasonable, and I think it is quite likely, actually, as the markets start to actually say to themselves, and investors specifically start to reevaluate their positioning in AMC based on this court date, April 27th, because when everyone is so bearish, it can pay to be bullish. And how do we know everyone's so bearish? Well, for the puts, the open interest is 88.22% for April 28th, and the calls open interest is 11.78%. You've never seen this before with AMC. Imagine the worst, bloodiest weeks you have seen. You have not seen this before. This is a brand new phenomena because of this court date on April 27th. Everyone is expecting that Thursday, April 27th, to be negative, and then they're expecting Friday to be negative as well. I'm not in that camp, and I do think that would cause potentially hundreds of percents of a rally in AMC stock in the next subsequent following days or following weeks, guys. So that is going to do it for this video. We covered a lot of ground in a short amount of time. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys also want to come trade with me live in real time, link down below in the description of this video. You get access to our trading community. Come ask any questions you want. Some members have actually been there for a very long time and have been growing their knowledge base, getting pretty experienced over there, so that's pretty cool to personally see, but also to hit some nice trades together is a pretty cool thing. I do send out alerts every time I do make a trade. Latest alert did come out today, and I think that is an overall interesting trade. But if you do join that, keep in mind it's not financial advice. You could be wrong, and I make it very clear that some of these trades are YOLOs. Let's be clear. Some of these are YOLOs, high risk, high reward kind of trades. Some of them are more strategic kind of, XYZ is why I'm doing this, right? Some of the YOLOs are kind of, the logic makes sense, but YOLOs can be pretty tricky to hit. But when you hit them, they can be pretty damn nice, guys. So there you have it. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.